Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about JINHAI Med Tech interim report. JINHAI Medical Technology Limited offers a diverse range of businesses and services, including minimally invasive surgery solutions, medical products, IT services, construction ancillary services, warehousing, cleaning, building maintenance, dormitory services, engineering, design, and consultancy services, manpower outsourcing for construction contractors, sales of graphene material products. The significant drop in JINHAI Med Tech's stock price by 33.33% in the past year can be attributed to several key factors. A substantial revenue decline of 44% in the first half of 2025, coupled with a net loss of SGD 10.25 million and a profit warning, have raised investor concerns. The company's increasing leverage risk, reflected in its rising debt-to-equity ratio and shrinking cash runway, has also contributed to the decline. These financial struggles have led to a very disappointing 23% drop in share price over the past year, highlighting the need for JINHAI Med Tech to address these issues to regain investor confidence. The primary drivers of revenue growth or decline are largely influenced by geographical markets. In the PRC, a minus 48.3% decline was observed, primarily due to low demand for dormitory services and adjustments in product mix on minimally invasive surgical solution business. Conversely, increasing demand for medical devices in China's growing market, driven by an aging population and improved living standards, contributed to potential revenue growth. Net income and profit margins decline in first half of 2025. The financial performance of a company has taken a downturn in the first half of 2025 compared to the same period last year. Net income has decreased significantly, from $7.4 million in 1H 2024 to $2.1 million in 1H 2025, and even more alarmingly, it has turned into a loss of $10.8 million. The decline in net income is also reflected in the profit margins, which have plummeted from 28.6% in 1H 2024 to 14.3% in 1H 2025. This drastic drop indicates that the company's ability to maintain profitability has been severely impacted. The reasons behind this decline are not explicitly stated, but it is clear that the company faces significant challenges in maintaining its financial health. The company's financial health, a stable outlook. A review of the company's financial summary reveals a stable outlook for its debt levels and interest expenses. Despite a decrease in lease liabilities from $2,731 to $2,129, the total finance costs have remained relatively unchanged at $349,000, 2025, and $347,000, 2024. Furthermore, while interest on bank borrowings increased from $127,000 to $210,000, this was offset by a decrease in interest on lease liabilities from $220,000 to $139,000. Overall, the company's debt level and interest expenses have shown no significant change, indicating a stable financial position. Regional performance review. The company's financial performance varied across different segments and regions. Notably, the People's Republic of China, PRC, and Hong Kong demonstrated strong growth, while the Asia-Pacific region as a whole showed impressive results. On the other hand, Singapore struggled to keep pace with its peers, underperforming in terms of financial metrics. This disparity highlights regional differences in market conditions and company performance. Management's outlook. A focus on efficiency and growth. The company's management is maintaining a cautious outlook regarding Level 3 financial instruments, indicating no significant changes to their strategy. However, they are adopting a more effective approach to managing internal funds, which will be used to acquire listed securities on the open market. This move aims to capitalize on opportunities for return through dividend income and fair value gains from investments in quoted equity securities. The company has made significant investments through acquisitions in recent times. Notably, it acquired 120 million subscription shares at a price of $0.35 per share. This strategic move is expected to bolster the company's financials and potentially drive growth. On the other hand, no divestitures were mentioned, indicating that the company has chosen to focus on expansion through acquisitions rather than shedding assets. That concludes the financial summary for JINHAI Med Tech. Feel free to comment below, and I will be happy to answer them when possible.